Okay, so we are starting the new chapter, which is called Receivables. Okay, it's very easy. Again, I will not be going to the study text in this. I'll be explaining over here in the notes because I want to keep it very short and simple. And in actual terms, the chapter is very short as well. It's not hard. It's very easy, and there are just two or three things to look at in this
Yes.
chapter. Okay, so basically, we will first be looking at receivables, then we will be looking at the bad debts. That is also part of this. And finally, we'll be looking at the allowance for receivables. So there are three things, three subtopics to be covered in this chapter. So first of all, let's
Yes.
look at what receivable is. Now, receivable, as you know, that this is arising whenever a credit sale happens, right? So whenever
Mhm.
a credit sale takes place, a receivable is created. And as you also know that receivable is an asset. It's treated as a current asset because it's less than 12 months. That's why it is a current asset. And what
Yes.
entry do we make? The double entry whenever there is a credit sale. So we do credit to the sales account and debit we do to the receivables account. So this is the entry for the credit sale. We don't receive the cash right now. We will receive cash after 20-25 days. But the sales is recorded there and then because the goods are transferred today. Okay. Now there is a T account which we need to understand. There is a similar T account for payables as well. But when payables chapter will be there, we'll study the payables T account. So receivables. Again, this is a asset, right? So always the opening balance of this will come on the debit side. Okay,
Yes.
but similarly, like payables is a liability, so the opening balance will come on credit side, but this is receivable,
Okay.
and
Mm-hmm.
closing will come on this side, on the opposite side. Now let me write the
Okay.
contents of the T accounts. So first of all, we write the credit sales on this
Mm-hmm.
side because this is the interpretation of this double entry. We do credit sale and debit in the receivables account, and only we write the credit sales if some of the questions in the examiner also confuses you in some questions, like he also gives you maybe the total sales and he says that this much amount of sales are the cash sales, so you have to exclude the cash sales, only write the credit sales in this T account. After that, all the cash that we have received from the customers we write on this side. Why we are writing on the credit side? Because the cash received, once the cash is received, the receivable is finished. There is no use of receivable anymore. And after that, we've got some more things like bad debts. I'll discuss this later in this chapter. Bad debts. And then we've got discount allowed. This we have already looked at. Discount allowed was there in this sales, and discount received was there in purchases, right? And there's one more word over here which is called contra. So let me explain this as well in just a minute. This contra entry, and whatever refunds that we give to the customer, the returns and refunds, those are also written at the credit side. Okay, and totals we get over here. So in the receivables account, in the questions we'll also see in the kit as well, it can ask you many things, like it may give you cash received, bad debts, opening balance, closing balance. It may ask you discount allowed. It may ask you the credit sales figure. So many figures can be asked. It's like incomplete records. There are several figures given, including the opening closing balances. Or what it can do is that opening balances and all the items are given. It may ask you the closing balance. So it depends on the requirement. But if you're clear about this T account, you can easily apply it in every question,
Okay.
right? So this was a T account for receivables. Again, you just have to remember that this is treated simple as a current asset. There is nothing else to remember over here. And you just need to know on what sides, on the debit and credit sides, all the items are written. Okay. So receivables has nothing much than this. This just has a T account and you just need to know the double entries. So let me also discuss the double entries over here. So for the cash receive, what we do is that once we receive the cash, we do debit cash, the cash is increased, and now obviously we have to finish the receivables over here. So credit, we do receivables. So this is the reason why cash received is written on credit side. Bad debts double entry, I will explain when we move to the next topic in this chapter. Discount allowed entry, you know that whenever we do discount allowed, the entry is first of all we finish the receivables, because remember this was a settlement discount, right? We receive the
Oh,
cash,
yeah, that's true.
and debit we do discount allowed because it was an expense. debit discount allowed. So basically it's also written in the receivable account just to reflect, because you see on debit there are two things. One is debit cash, then there is discount allowed. So basically the whole receivable amount consists of two things, right? Discount as well as cash. So some things we lost and some things we received. So that's why discount allowed also decreases the receivables. And now let's talk about the contra entry.
So
So
you credit, sorry, you
yeah,
credit receivables with the whole amount, and then you put the cash that you actually received, and
exactly,
uh,
yes.
okay, that's fine.
That's right. Let me write the words over here as well. So in cash, we wrote the net because we received the cash after deducting the discount.
Yeah.
And in discount, we just write the discount. This was a treatment. Okay.
Yeah.
So let's now discuss the contra entry as well. So contra, basically this word came from the word contradicting. So let me write the full word over here. One second. Contradicting entry. So contradicting entry basically means that anything which is offsetting the other two, right? So it's a very easy explanation for this. So contra basically means when your receivable is also your payable, or you can turn it the other way around as well. When your payable is your receivable as well. So let me give you a small example. Like let's say we had a customer which was Mr. A. This was our
Yeah.
customer, and let's say he owed us $5,000 we had to receive from him. So obviously he was a receivable because he was the customer, right? At the same
Mm-hmm.
time, he may be running a business as well. He might be a seller as well. So we might have purchased some goods from him as well, right? So at the same time, we did some purchases from him, and now we owed him because we purchased on credit. So we owed him, let's say, $1,000. We purchased goods amounting to 1,000. So you can see over here, he's a customer as well, and he's a supplier as well. So in other words, he is the
Yeah.
receivable and the payable, both things. Okay. So what happens is that basically in the contra entry, we have to offset the receivable and payable, because these contradicting entries are not believed to be a fact in the financial accounting. So financial accounting experts just say that just delete the receivables and delete the payables. Okay, so what we do is that we don't offset, we account for this separately and for this separately. So for the contra entry, what we do is we finish the receivables. This is the double entry for contra. Credit
Mm-hmm.
receivables, and debit we do payables. So that's why you can see in the receivables account, the contra is written on the credit side. Because at the end of the day, we have to delete both accounts. We have to delete the payable as well, and we have to finish off the receivables as well. Both things we have to decrease. And obviously, payable decreases on debit side and receivable decreases on credit side. So this is the double entry for contra. Let me make a box over here. So this was a double entry for the contra entry. And similarly, opening closing balances are written just like normal. All right, I'll send you the notes as well after the class once the
Yes,
chapter is
please.
finished. So this was whole of receivables chapter. There is nothing much. Obviously, there is a lot of theory in the book. So if you want to learn more about this, the theory and everything, which is just I think unnecessary, so you can read it from the study text as well. Now let's move on to the next one, which is bad debts, because most important thing over here is doing the questions of this, right? So once we are done with all the
Mm-hmm.
concepts, after we'll do the questions. So bad debts, let's discuss it. Now, bad debts is also included in this receivable chapter. The reason is that this is very closely and related to receivable, and it's very similar to that. Okay. So what happens is that whenever we do a credit sale, there is a high risk that we have now delivered the customer the goods, right? We have delivered the goods to customer,
Yeah.
but the risk is that he has not paid us right now. And for this, the word used in the accounting world is credit worthiness. So most big businesses, those are the listed businesses, the very high companies, they first assess the credit worthiness of the customers. And after that, there are very much agencies in the world. You can also find, like public results on Google as well, like what is the credit worthiness of Toyota, for example, let's say Coca-Cola, car manufacturers, Honda, and every kind of business. So they have, the public companies have their credit worthiness. This means that how probable are they to pay the amount that is due on them, right? So how liquid are they? This is basically called liquidity. How can they manage their liabilities? So what happens is that there is a great risk that these customers end up not paying, and it's a loss for the business, right? And similar thing is happening in this bad debts. So the explanation for this would be, whenever customers uh, get the goods without payment. So basically, they never pay us. If we are the sellers, they never pay us. So we never receive the payment over here. So obviously, it is a loss. It is kind of like an expense for the company because we have to offset the loss as well. So what we do is that we offset it from the profit. So in simple terms, we just expense it out in the financial statements. So the simple entry for this will be, now you see the originally balance of the customer is written in receivables, right? So what is the original entry right now? We have done this entry till now before the bad debt: receivable, debit, and credit sales, because we have already transferred the goods to them. Now it's currently lying in receivables, right? So what we do for bad debts, the entry is over here. We do debit bad debts. The reason I'm doing debit bad debts is that this is an expense, so we have to account it as an expense. And credit, what we do is credit, we do receivables. So why am I crediting receivables? Because I'm finishing the receivable. It has become a bad debt now. So it's no longer my receivable. I cannot expect him, the customer, to pay me the money now.
Okay.
Okay. So that's why debit bad debts and credit receivable. Now,
Yeah.
sometimes there is also a scenario like this, that the bad debt is recoverable, is recovered. So the customer is, just shows up after 2 or 3 years out of nowhere, and he says that here is your balance, I forgot to give you, right? And obviously all the people are very surprised. So what happens in this is that now we finally receive the cash from that bad debt customer. Now already we have expensed it out in a financial statements, right? So there is no way of reversing that. What we do is that we debit the cash because we receive the cash from the customer, and now it's not lying in receivable because we have already finished the receivable over here. You can see credit receivables, right? So what we do is we reverse the bad debts and we show it as an income in the financial statements. So in simple terms, what we do is debit cash and credit bad debt. So in simple terms, we just reduce the expense that we created 1 or 2 years before. We just reduce that on the credit side. So these are the three cases in this. First, I explained you that what actual entry is made, and then what happens when a bad debt is arise. And after that, when a bad debt is recovered, then what happens is that we receive the cash and we finish the bad debts. Right. Now let me make a bad debt T account over here as well. So bad debt also has a T account, and this is treated as an expense. So the written off bad debts itself are coming on the debit side. The recovered ones are coming on this side. Now there are two more things in this that I will write in this T account after completing the third thing that we're going towards just right now. Okay, so this was the whole thing regarding the bad debts. We studied the bad debts double entry, the explanation, how they are recovered, and also the T account. Now the last thing over here is basically the topic which is known as allowance for receivables. This is a very interesting topic, and it has a very interesting discussion as well. So let's discuss this. Allowance for receivables. Okay, so in the start we discussed receivables. Receivable was very simple, that whenever we do a credit sale, we create a current asset which is known as a receivable. That means that we are waiting for the customer for the payment. Okay. Now allowance for receivable is basically, there is one additional word over here, allowance, right? So what happens is that this is basically a market based figure. I'll explain it just from the start, just from A to Z. So it is a market based figure. And what happens is that this, in simpler terms, if I explain it, it is a tolerance for bad debt. So tolerance for bad debt, in simple word, this means tolerance for bad debts. There may be different kinds of definition for this, but it's very simple to understand it like this. Okay, so what happens is that according to the market conditions, according to the industry results, maybe a medicine company who is operating in pharmaceutical industry, obviously, so it might have separate kind of allowances made for receivables. Maybe a automotive industry, the car industry, might have different kind of allowances made for receivables depending on the transaction frequency and all these things. Maybe a retail industry may have separate kind of allowances, right? So again, the thing is that they are market based figures. Now, every kind of allowance will have, in every question, there will be first an opening balance for this, and then secondly, there will be a closing balance for this. So this is basically the opening balance, and this one is the closing balance. Now, opening balance basically means that what was the balance basically at the end of the last year, because the balance at the end of the last year will be the current year's opening balance. The thing which
Yeah.
we closed the last year's accounts will be the opening for this current year, right? So this will be the opening, and we will compare it with the closing. So we'll do the question in just a while. So you'll get 100% sure that how we account for these. Now, there is also a movement between these. So movement I'm going to explain according to the market-based figures. So I will explain these with the practical examples. So first movement is called increase in allowance, increase in allowance, and second is called decrease in allowance. Okay, but one thing before this, let me explain one more thing over here. So what happens is, let me take an example of opening balance. Let's say we've got an opening balance of, before this one thing happens, let's say our total receivables were 500,000. Our total receivables for the year were $500,000. And there is a specific percentage that is set. This is set again, this is a market based figure. So all the valuers or kind of like different departments sit together and ascertain this percentage. So let's say the opening receivable allowance was 10%. This was the opening. So this means that the 10% will be 50,000, right? 500,000, 10% will be 50,000. So opening I'll write over here as 50,000. Now let's say the closing, I want to make it, let's say for example 20%. I want to jump from 10% to 20%, right? So this means that this will give us the answer of 100,000. So closing balance, I'll write it as 100,000. So what this means is that first only 50, basically out of 500,000, only 10% balances were doubtful. They had a doubt that maybe they'll pay, maybe they'll not pay. So basically in the book, you'll also see this word, that the full word for this is allowance for doubtful debts. It can be called allowance for doubtful debts as well, or it can be called receivables as well. Okay, so doubtful debts basically means we have not actually brought it in the bad debts. We have not made the entry of debit, bad debt, credit, receivable. We are just doubtful that they may pay, they may not pay. There is very much uncertainty in this. And obviously if it's a market based figure and an industry based figure, so there is very much uncertainty. So what happens is that let's say the opening was 10%. So 500,000, 10% is 50,000. So that means out of 500,000, I was doubtful that 50,000 will pay or not pay. I was very doubtful, I was very stressed, right? So this means that the remaining 450,000 will pay, right? This is the simple meaning of this. The remaining 450k will pay us. This is the certain thing. There is no uncertainty in the 450,000. The only uncertainty lies in this $50,000, right? So this is the opening balance. Now the uncertainty has rise to 100,000. You can see. So 100,000 means that now first the uncertainty was 50,000. First the doubt was of 50,000. Now the doubt has gone up to 100,000. So this means the market conditions have worsened, right? Let's take an example of COVID, for example. So COVID came in 2020. If I talk about here, it came in March 2020 and April 2020. The cases start to rise. So what happened is that businesses started to close. Cash shortage was very much severe among the business. So this means that this is a perfect example that now we are tolerating more amount of doubtful debts. So again, the meaning was tolerance for bad debts, right? So this means first the doubt was of 50,000, and secondly, or at closing of the year end, the doubt is of 100,000. So this means that the market conditions have worsened. Now this brings me to increase and decrease. Now let's discuss this. So increase in allowance means that market conditions have worsened. And on the opposite side, let's see the decrease as well. 1 second. So decrease means that market conditions are improved. So let's say in 2021 and 22, now all businesses are flourishing. They are not facing any cash shortage anymore because obviously there are no lockdowns, etc. The cases have gone much down. Vaccines are here, medicines are here that can be, that can heal the COVID-19 patients. So what happens is that increase is much dangerous for the company. That's why this will be expensed out. Always this will be expensed out. So everything which is bad for the company is expensed out. This is the basic rule. And everything which is good for the company, you can see the decrease in allowance, the market conditions are improving. So everything which is good for the company, this is treated as an income in the statement of financial positions and the statement of profit or loss. So it is treated as income in the financial statements. Now let's also look at the entry. So always remember that allowance, let me write over here, allowance is basically treated just like liability. It is actually not a liability, but it is treated as a group 2 items, like we did sales, income, liability, capital, right? So allowance is also a part of group 2 items. So it's increased for debit, credit, and it's decreased for debit. This is the treatment for allowance. So if we are increasing the allowance, what we have to do is that we need to credit the allowance for receivables, and what we do is that there is a simple form, it's written in the book as well, that some companies, what they do is that they write this expense and this income separately in the financial statements. But now the rules have become very simple. The financial accounting experts and the basically financial records and the financial standards have set a rule that we can record this expense straight away in the bad debts account. Okay, so what we'll do is we'll do debit bad debts. We can record it separately as expense as well. But if we are debiting bad debt, it means the same thing, right? We are increasing the expense because increase in allowance is the expense over here. So credit allowance and debit, we do bad debts. And what about decrease in allowance? This is a good thing for the company because now cash shortage is not anymore. Market conditions have improved. So this is the income, right? So similarly, we'll decrease the allowance over here. So what we'll do is debit allowance for receivables, and similarly we'll decrease the expense account which was bad debts and credit to expense, and credit usually means that this is written as an income, right? So credit will do bad debt. So this brings me again to the bad debt account. This I was explaining that two things are left over here. So the increase in allowance will be written on the debit side because it's increasing, it's helping, it's contributing towards the expense, it's increasing the expense. That's why it's written on the debit side. And the decrease, it is a good thing for the company. So the decrease is treated as an income, or you can say decrease in expense. So decrease in allowance will be written as a credit in the bad debt account. Okay, so these will be the totals over here. And this is basically the whole chapter for the doubtful debts as well. So what happens is, let me explain this over here as well. I made the opening allowance as 50,000 over here, right? Has increased, right? The market conditions have worsened over here.
Sorry,
So this means that there is an increase. Yeah.
Sorry, opening balance of 50K. I mean, is going to be on the credit side.
On the allowance account, yes, it will be on the credit side. Because it's being created, right? It's being existed first.
Yeah.
But the movement between them, increase and decrease, this will be accounted for as a group 2 item. And the
so increase debit and decrease is credit. Yeah.
The increase is credit and the decrease is debit.
Yeah.
Just like a liability or capital. Okay. So
yeah,
the increase between them is $50,000. So this movement will be written as an expense in the financial statement because this is an increase. But if the other thing around that happens, like if we are bringing from 100,000 down to 50,000, that will mean that this is a decrease and will be treated as an income in the financial statement.
Okay. Okay.
All right, that's great. So basically, all of the chapter is done. There is nothing else to discuss over here. I'll send you these notes as well. Now let's take a short break, like 4 or 5 minutes, and after that we'll start the exam kit questions. Okay.
Okay. Thank you.
All right, let's begin with the questions of the bad debts and allowance for receivables. Okay, so in total, I think there are around 15 to 20 questions. So I'm going to do 5 or 6 questions with you, and the remaining one you can try over this week, and we will discuss if there is any problem in them. Okay, so first of all,
Yes, I will let you know, if there is any problem on Friday. I'm going like to go through all the chapters, from the first one until this one by
right.
Friday. I will let you know if there is anything that I don't quite understand.
Sure. That sounds good. We'll discuss all the problems, whichever that you're
Okay.
having. Okay. All right.
Okay.
So 166 is the first one. So what was the net receivables figure reported in the statement of financial position at 31st December 2016? So there is one more word which is called net receivables. Let me explain this in the notes as well so that you can remember this. So what happens is
Yeah.
one figure is the normal receivables figure, which is simply called the receivables, but one figure is called net receivables. So this is also connected with this. Let me explain the logic in this. So net receivable basically has the formula. It's a very simple formula. What we do is that we write closing receivables and we minus the closing allowance from this. So the formula is closing receivables minus the closing allowance, and we get the net receivables figure. So what's happening is that basically we are excluding the uncertain figure from the receivables figure. So it's the same thing that's happening. Let's say the total receivables are discussed over here. It's over here. So you can see 500,000 were the total receivables, right? And
Yeah.
let's say the closing receivables that I create over here, the closing allowance was 100,000, right? So if I take 500,000 out of this 100,000, 100,000 I take it out. So that means the uncertain figure is now taken out, and I will be left with the answer, which is 400,000. Now this means that the net receivable figure is the most certain figure that we can get. That means that this 400,000 amount, which we will certainly receive, close to 100% chance there is that we'll receive this amount. Only the uncertain
Mhm.
figure was the 100,000, that there may be some balances which we may not receive from 100,000 out of these 100,000, but these 400,000, there is no second thought on this. We will receive these all of these amount. So you only need to
Okay.
remember the formula of this: closing receivables minus closing allowance. Now let's see this question. So whenever we are creating a receivables account that we discussed in the start of the slides, we'll always create the normal receivable balances. The net receivable figure is only included in the financial position. You can see over here. For making
Yeah.
the T accounts and for the chapter purpose, we'll just use the normal receivable figure over here. Okay.
Mhm.
So in the statement of financial position at 31st December 15, Boris reported net receivables of $12,000. Okay. So you can see the opening balance it's given over here because this is the closing date, right? 31st December 16. So 31st December
Mhm.
15, this is the opening one. So he reported
Yeah.
the net receivables. Now these are the net figure, not the original receivable. So obviously we have to include them in the T account for finding the missing figure, right? The closing balances we have to find. So we need to convert them
Mhm.
first into the normal figure. Okay. Now first let's read the whole question, then we'll do the solution. During 2016, he made sales on credit of 1,25,000. So these are the credit
Mhm.
sales, and received cash from credit customers amounting 115,500. So this is the cash received. Now these are the closing balances at 31st December X6. Boris reported to write off debts. Okay, there were bad debts as well, 7,100, and increase the specific allowance for receivables by 950 to 2,100. So this is basically the increase in allowance that we are reporting over here. So what we do is that over here, let me create a receivables account. So this is a
Yeah.
receivables account. Now these bad debts, these 7,100, these are already given at the year end, right? So that means there is, I think there is no need for including the closing allowance over here, the closing or opening allowance. The closing or opening allowance is just given for the net receivable figure over here. Now let's first write the opening of the receivables. Now I told you whenever we are making the receivables account, we have to include the normal receivable figure, not the net receivable. So you can see the opening net receivables are given 12,000. So let's convert these into the normal receivable. So net receivable formula is closing receivable minus closing allowance, right? So what we do is that net receivable figure is given, right? 12,000. And
Mhm.
what is the closing receivable that we need to find? Basically, this is the opening, but the same thing we're doing. Receivable, we'll leave it as it is, and minus the allowance. Now, what was the allowance? This is the opening figure, right? So we need to take the opening allowance, because this net receivable will come how? 12,000. We might have minus the opening allowance from this, right? So we are just turning this opposite way around. So you can see that. Let me now tell you that how to figure out the opening and the closing allowance. So this line is very important. Increase the specific allowance for receivable by 950 to 2100. So one thing is for sure, that closing allowance is given in the question. It will be given to you in every question. In this question it's 2100, right? Now it's written that he needs to increase it by 950. So many students do this mistake. They don't read it carefully. So opening allowance, they just write it as 950, but actually it's not 950. They increased it by 950 to 2100. So that means there will be an increase in between of 950, right? And this way we'll reach the opening figure. So if we minus 950 from 2100, this way we'll get the opening allowance. We're just moving back in this. Okay. So opening allowance we are getting as 1150. So you can see if we add 950 and 1150, we'll get to 2100, right? So that means the opening allowance we have got, and this is 1150. We'll write it over here. So for finding the normal receivable figure, what we do is 12,000 plus 1150. We just apply simple maths. So the normal receivable figure is 13,150. And this figure we can include in the receivable account, not this 12,000, because this is net receivables. And net receivables,
Sorry. Yeah.
yeah, yeah.
So on, I mean, um, so that net, the opening balance is 12K, okay, but
Yes.
that net, so is less all the allowance. So we need to basically account for an increase or decrease, and that will be the opening balance.
Basically, what we're doing is that, let me explain this again. The net
Yeah.
receivable figure is always written in the statement of financial position. It's never used in the
Yeah.
T accounts, right? So if we are using the accounts of the T account, if we are using the amounts, we need not to use the net receivable account. We only need to use the amount of the normal receivables. So for converting it to normal receivable, we use this net receivable formula. Because you can see the opening amount is given as 12,000, and this is the net receivables, but we need to take out this net word. So for taking it out, we need to apply this formula. So just think it as this way, that this 12,000 is current year's opening balance, right? It might have come from
Mhm.
previous year, and previous year it was a closing. So previous year it was calculated as this figure, and the normal receivable figure is 13,150. So this figure we can successfully use in this account, which is the opening balance 13,150. We are just converting the balances just for the sake of T account over here. Now we are writing
Okay.
the correct figures.
Yeah, I'm going to write this down. Sorry, just one.
Yeah, yeah, sure, sure.
Okay.
All right. So let's continue the question. So what we're doing is
Yeah.
that we are writing the normal figures now. So the credit sales were 1,25,000. We write this. And now on the other side, what we write is cash received. So how much cash that we have received from the customer? It's 115,500. 115,500. And I think there is, let's see, yes, there is bad debts as well. So bad debts are 7,100, right? And finally we have got the all the amounts correct. Now what we have to find is, what was the requirement again? What was the net receivables figure reported in the financial position? So again we have to convert the closing balance again into the net receivable. So first let's find the normal closing balance. Let's find it over here. So first let me write the totals over here. So 1 second. This is 138,150 and 138,150. So if I minus 115,500 and 7,100, so you can see I'm getting the closing receivable figure of 15,550, 1,550. So now this is the normal receivable balance. This is the normal receivables closing balance. We need to convert it again into net receivables. So again, net receivable formula was closing receivables, which is this one, 15,550, right? And closing allowance was minus. So closing allowance is clearly given in the question. I've also written it in a graph over here. 2,100 was a closing allowance. So if we minus this uncertain amount, which was 2,100, this means that out of 15,550, we might not receive the 2,100 amount. So the certain amount, and which is in other words called the net receivable, that is 13,450. So this is the correct net receivable figure, and this is the closing balance. So if we write 15,550, we'll get the answer wrong, right, which is D. But the correct answer is 13,450. So B option over here would be correct. So in the requirement, we'll have to see what question is the net receivable and what requires us to write the normal receivable figure. And if you remember this formula, closing receivable minus closing allowance, you can easily formulate the net receivable figure.
Yeah, it's just, it's the opening balance that is a bit like.
Yes, exactly. It's a little bit confusing, but the easier thing over here, what you can do is that just remember it as the current opening balance was coming from the last year's closing balance, right? So similarly, the closing balance we got over here, this will also be accounted for the next year's opening balance. So if you understand the relationship between these both, the net receivable will automatically be very easy for you.
Okay, that's fine.
All right, now let's do the 167 next question. This is a very similar one, but it's a very simple one. So what is the revenue figure? We need to find the sales figure reported by Putney in the year ended 31st December 2018. So these all are the transactions. What we need to do is, again, the missing figure is sales, right? The credit sales. So we need to first write all the figures in the receivables account and find the figure over here. So let us make a receivables account over here.
Yeah.
So this is a receivable. Now let's write the opening and the closing. So opening, you can see this is the figure for the opening, 34,500, and this one is the figure for the closing. So 34,500 and 45,000. 45,000. All right. Now the next thing is cash received from credit customers. So 247790. This is the cash received. It will be written on this side. 247790. And now contra with payables 1200. So we are making the receivables account here, right? So receivable is to be credited with contra 1200. And cash sales we don't include because cash sales are not part of the receivables because they are settled in cash, right? Now irrecoverable debts, these are 18,600. Let's write these as well. So 18,600. These are the bad debts, right? And what else have we got? Discounts received. No, these are also not included in the receivables because these are received. We only include the discount allowed, right?
Allowance. Yeah.
Yes, and the increase in allowance has nothing to do with this because this is a portion for the net receivables or like a bad debt. So all of these things are written and the credit sales will be shown over here. So let's total these figures. And 45,000 plus 1,200 plus 18,600 plus 247790. So this is giving us 312,590 and 312,590. So if we minus 34,500 from this, so we are getting the answer. 1 second. Yes, this is 278,090. This is the credit sales amount. that is 278,090. So correct option over here would be option B, 278,090.
Sorry, why the allowance is not in the T account?
Because you see, this is the T account of receivables. We are not making a T account for the bad debts. Only the increase and decrease, the movement is written in the bad debt account. Got it? Okay, now let's do the next question. 1 second. Okay, 168. So in this question, you can see that it's the person has made the wrong account over here. So after amendment, what is the correct receivable balance carried forward? So they're asking us to calculate the correct closing balance of this account, and you can clearly see that the amounts are written on the wrong side. So this also tests out the concept of the receivables. Let's make a receivables account over here. Opening, closing. Let's write the figures first. Cash received, sales, contra, then bad debts. Okay, then we'll write the extra things. Now opening balance is 84,700. So we'll write this 84,700. Now the credit sales, we only again need to write the credit sales, not the cash sales. So 644,000, 644,000. And cash received from the customers, it's written over here, 625,780. So 625,780. And how much is the contra entry? It's written over here, 5,000 contra with payables. So 5,000. And let's see if there are any bad debts. Yes, there are 4,300 bad debts. 4,300. Okay, and again the allowance for receivable, this is written wrong. This is only part of the bad debt account, but usually the bad debts are the final amount, and this is normally used for the net receivable figure. So all the accounts are included. Discount received, again these are not included, so we will not write this because this is a payable item, not a receivable item. Now let's find the correct closing balance over here. So the heavier side would be the debit side. So plus 84,700, 728, 700, and 728, 700. Now if we minus 4,300, minus 5,000, minus 625,780. So this is giving us the closing balance of 93,620. Let's see. Yes, I think the correct option will be option B. And this is the correct closing figure, closing balance figure of the receivables account. So we just need to make sure that the correct amounts are being written on the correct side, and what things comes on debit, what things come on the credit side. All right. Now let's do this last question, which is 169. This is a question purely related to the receivables allowance, right? And the remaining ones.
Sorry, can you go to the first exercise that we did? I just want to ask you a question.
The first question.
Yeah.
This one, right?
Yeah, 166. So I mean, if the net receivable, that one is at the end of 31st December 2005, right?
Yes, that's right.
1,000, yes. But, you know, I mean, if that one is the opening balance, the written off debts and increase the specific allowance, that one is going to be like during the year. So why do we have to modify the opening balance?
Yes, we have to modify the opening balance. This is the reason, because again, I told you that in the receivables T account, we always write the normal receivable account, not the net receivable, right? So if we are including the net receivable account, this will change the receivable, the whole figure. It will just disrupt it. So only the net receivable figure, this NR figure, will only write in the statement of financial position just for reporting purpose. But for the calculation purpose, for the T accounts, we'll only include it just as normal receivable account, which has the uncertainty involved in it. So you can see this 13,150, the figure that we converted into normal receivable, this has the uncertainty of 1150, right? And this 1150 was the opening allowance. In other words, it was the closing for the last year. right? So the uncertainty figure are only
Yeah,
included
but I mean this allowance from 950 to 100, 2100, as I mean, is going to happen in the future. So how do we know that
this
at
is
the
during the year. Yes, this increase,
2006?
this 950 increase, this happened during the year, right? But for the sake of question calculation, they will be given to you. Yes, obviously in real life this does not happen. This 950 will be incurred during the 12 months, right? We will
Yeah, so
get to know.
how do we know that at the beginning of the year that we are going to increase that by 950?
For the question purpose, we'll have to do this. Because in practical life there are many other factors to consider, right? In the real life, in the business life, but in the question purpose, you just need to remember that the increase will be given to you beforehand, the increase and decrease. So this will be done in this way, right? The obviously the practical life things will be coming in the further papers, because there are many other factors to consider in this. Like again, I told you, you will be tested in F7 exam, the next one, that how we calculate this increase decrease at what point of time,
Okay.
right? But
Okay.
for at this point, you just need to remember that increase or decrease the movement will be given to you in the question.
Okay.
All right. Okay, so this 169, let's do this one. So what is the charge to the statement of profit or loss in respect of the above information? So again, whenever it asks you what is the charge, so we have to make a bad debt account in such scenario, because charge basically means that what is the expense. So the only expense in this receivable chapter is bad debt, and we include the increase and decrease within this figure. So Neville's receivable ledger control account shows a balance at end of year of 58,200 before making the following adjustments. So number one, Neville decides to write off bad debts amounting to 8,900 as he believes they are irrecoverable. So this is the figure for the bad debt amount. Now he also decides to make specific allowance for Carol's debt of 1350. Now whenever there is a sign to pick up in the exam and the questions as well, if you want to calculate the closing balance, you will see such words like he also decided or he wishes to make, right? So these kind of words, decided or wishes, these indicate that he is creating a closing balance, like he wants to make the allowance to the closing of that figure. So it basically means that he is deciding to keep the closing figures as these one. So he's either increasing or he is decreasing. This tells the future. Okay. So Carol's debt of 1350, Duff's debt of 750, and Mary's debt of 1416. So let's first calculate the closing allowance. And let's see. The opening is, by the way, given over here. Neville allowance for receivable at previous year end was 5650. So opening is 5650. Let's calculate the closing. So 1350 plus 750 plus 1416. So this is 3516. The closing that we're getting is 3516. So you can clearly see there is a decrease in between these both. And decrease means that market value, the basically market has been improved
Sorry,
right now.
how do you calculate the closing balance?
I just added all these three amounts, 1350, 750, and 1416. Because in the question, it will tell you some figures, some signs that he also decides to make the allowance. He also wishes to make the allowance. So this decides and wishes, these two words basically indicate that he's trying to make the allowance to this figure. And this means the closing balance. Okay. So he's decreasing the figure in between them. So there is a decrease. Let's see. 5650 minus 3516. So there is a decrease of 2134. So that means this decrease will be written as income, or in other words, it will be credit to the bad debts, credit to bad debt account. Now we need to tell the total charge. Let's see what is the total charge. So I'm just going to do it without the account. You can do it with the account as well. So first charge is 8,900. This is expense, right? And this 2134 is income, right? So this will decrease the bad debts. We'll do credit bad debt and debit allowance, right? This will be the entry. So what we do is that we just minus from this because it's an income, right? So it's decreasing the expense. So 2134, this is a decrease, and this will be minus from the bad debt. So same thing is happening if even if I make a T account, bad debt T account. This is bad debt, right? So written off will be written over here. These are the bad debts, and the decrease in allowance is written on this side, 2134. So the same thing is happening, it's being minused over here. So 8900 minus 2134, this is giving us the figure of 6766, right? So this is the correct answer, which will be option A, 6766. And this is the final charge, because the charge basically means to net off all the figures, like recovered balance, the bad debts written off, increase, decrease. After adjusting for all the items, we have to tell the final charge.
Sorry,
So this,
bad debts are irrecoverable debt.
yes, exactly. So bad debts and irrecoverable both have the same meaning. Audit.
Yeah.
And we just adjusted for the allowance over here, and we got the final figure of 6766. Okay, so we have successfully completed the receivables chapter as well. Again, this was much simpler than other chapters, like especially accruals and prepayments, which was much harder to remember. And remaining questions, you can try it by your side. And if you have any problems